They need money to hedge. Winning clients are annoying for two reasons to the broker. One, because the OTC gain is eliminated, so they only make money on 3 revenue streams. But 2, they have to commit twice as much capital relative to a losing trader because they have to hedge. So winning guys cannibalize the broker's capital. So they're annoying. Losing traders are fantastic because they get the 4 revenue streams and they use X capital to trade with that client. Winning traders are annoying because they make less money and commit twice as much capital, 2X. So remember this trend over the last 30 years, the monopoly-duopoly situation? Where's the credit coming from? It's coming from the investment banks. This is the value chain or supply chain of liquidity in the trading and portfolio management industry. Who owns the narrative? What's the perfect retail broker to lend money to? One that peddles the narrative. Why? Because the investment bank can lend them money and make money out of it forever. So it's starting to add up. There's a monopoly-duopoly situation with exchanges and investment banks. Who are the biggest clients of exchanges? Investment banks. More on this later. But smart money and dumb money. This is why we labeled smart money on the professional side, investment banks, prop desks, dumb money on the right-hand side as the retail traders. Smart money understand how the financial markets work. They understand conflict of interest. It's professional trading 101. It's the stuff you get taught in your first couple of months at Goldman Sachs or any firm that's good. They avoid trading in the way that other participants in the market who have conflict of interest want them to. They avoid it. And they do everything in the opposite way to the way retail traders do it. What do dumb money do? Believe everything they're told and rely on the infrastructure provided to them by financial market participants with conflict of interest. Believe that the infrastructure has been built for their benefit when it's actually been built for the opposite purpose. They trade in the way that they're told to trade, and they do everything in the opposite way to the way professional traders do it. But there's a catch. We talked about it earlier with the non-farm payrolls example. That's very typical. Smart money requires dumb money to exist. Who's supplying the credit facility? The investment banks. Who's the perfect broker? The one that peddles the narrative. Who's the perfect client? The client that believes the narrative. And it creates the negative feedback loop, and the professional traders win. We can also add hedge funds and pension funds into here. So in the grey box on the left, hedge funds are smart money. They're basically exactly the same as investment bank prop traders. Pension funds are slow money. They're investing over a long time. But the key here is they are the market participants that are on the professional side, and they are the biggest clients of investment banks. And combined, investment banks, hedge funds, and pension funds are the biggest payers of exchange fees on the planet, and 2 companies own 90% of the order flow on all exchanges in the world. It's a monopoly. So what you're looking at, ladies and gentlemen, on the left-hand side is Wall Street. And if you don't think they all work together, you've got your head up your ass. There's not many of them. 6 or 8 investment banks control 90% of the volume. And everything on the right is dumb money and the inversion narrative. So everything we've discussed regarding the structure of the industry outside the US actually applies in the US too, but the CFDs were banned in the US in 2010. So what's happened since? Retail traders have been moving more towards trading options in the US. So they obtain their leverage through essentially implied leverage or implied volatility through trading options. If you wanted to actually trade normal physical assets in the US, the margin requirement is pretty high. So you don't get much leverage. It would be 33 to 50% margin requirement overnight. So 2 to 3 times leverage. And why do you think it's restricted in that way? They banned CFDs and that replaced it. And then everyone's going for options to get leverage. Index, Forex, and commodity futures, there's lower margin requirements, but the tradable set is pretty small, as in your amount of opportunities to make money because of the amount of contracts or assets you can trade is very low. So it's about 60 contracts, typically on a retail brokerage platform. And that compares to potentially 42,000 stocks. So your tradable universe is really small. And this is why options contracts have become very popular in the US, because retail traders can deposit less margin and get potentially much higher return if they make money through trading the option of an asset. And this is obviously a totally separate class in terms of options, but the two most important variables to consider with an option are theta, so time decay, and volatility. Theta, you have to be right by a certain date. Options adds this other element to a trade whereby you're not just long something and you can be long forever. You have to be right by a certain date. Otherwise, your option expires worthless. Volatility. Why is volatility important? Well, the more volatile something is, if volatility goes up, there's more opportunity to lose or make money. Well, risk and opportunity in the asset. So what happens when volatility gets bid up? When volatility goes up, options become more expensive. And retail traders don't understand how to calculate volatility and opportunity properly. So they always, for example, go long something and buy the asset at a level of volatility that doesn't even exist in the real market. So the odds are always massively against them. So what happens in the US is the vast majority of options expire worthless. Retail traders in the US use options as a proxy for simply going long or short the underlying asset without realizing that they have to be right by a certain amount of time, or the volatility that they're either going long or short can't be bared by the underlying asset's real volatility. But there's a very obvious question here. If 70% of options contracts in the US expire worthless, why don't you just sell options all day long? Easy money, right? Wrong. Selling naked options as a strategy constantly just to take money in, as in to get an income, is super dangerous. Why?
Unlimited losses.
Unlimited losses on many of the trades, yes. So if you do that, it's basically like picking pennies up off the railway track. You're playing a very dangerous game.